Good morning, everybody. Hi, Eric. How are you?
Morning, Ed. I'm good. How you doing?
Hey, well, today is Monday, August 26th, and as we've got this routine where we like to get together with you folks and discuss recent events in the financial markets and where we're heading. Clearly, the biggest event recently occurred on Friday when Fed Chair Jerome Powell addressed all of us, the nation, the world, with his latest thoughts on monetary policy at the Jackson Hole conference with the Grand Tetons in the background. It's a beautiful area, though. It looks like the weather kind of comes and goes in that part of the world. My wife and I visited a couple of years ago, and it was kind of rainy and cloudy, so you couldn't see the mountains all that well. But it's a beautiful part of the world, and it always seems to be an important speech delivered by the Fed chair. And I guess what Eric and I were kind of confounded by is how dovish Powell was. You agree with that, Eric?
Yeah, I mean it was pretty different than the tone he's been striking at every press conference and speech for the entire year, really.
Yeah. And then, even a month ago, Eric, in his press conference following the last FOMC meeting, he basically said that the risks of uh, for the dual mandate were balanced. And he basically indicated that he was kind of happy that inflation seemed to be still on course to be coming down, but wasn't quite there yet. So there was a risk that it might stop moderating or even start increasing, but he didn't view that as a terribly high risk. At the same time, he seemed to be okay with the unemployment rate. It was 4.1%. And it's just hard to imagine that with the unemployment rate going up from 4.1% to 4.3% over this 30-day period, that he kind of freaked out about that. Maybe he freaked out about the Bureau of Labor Statistics revision to employment, that it was the level for March 2024 turned out to be down by over 800,000. So maybe that was it. But Erica, I think we're starting to develop kind of a theory here that maybe he just really likes his job and wants to keep it, because I think we both got the same kind of deja vu all over again sense that didn't we just see him kind of play this wokish tone of we're going to do whatever it takes to keep the unemployment rate down. That's what I recall him doing right before inflation took off.
Yeah, a few years ago when he was trying to be renominated by Biden, they were still buying a ton of bonds on their balance sheet, keeping pretty easy policy when CPI was already at like 7%.
Yeah.
Um, so yeah, I think it's more reminiscent of that than any fundamental shift in how he's thinking
Yeah.
about the economy.
Yeah, I mean, I don't like thinking those thoughts, but like I said, the similarity between his sudden uh, extreme dovishness and what happened right a few months before it was time for him to be renominated. I would have thought that after having quite a successful career on it, all in all, just really one miss. Just a little late on bringing inflation down, but it has come down. The unemployment rate is down. I mean, in his speech, he basically suggested that the Phillips curve is dead, that there's no
Hmm.
longer any trade-off between unemployment and inflation. He basically indicated that he thought that he could keep the unemployment rate down around 4%, and that inflation would come down to 2%, and we'd live ha happily ever after. And man, that's a pretty good legacy to go out on. And
Yeah.
I didn't really think that he'd want another shot at it, but maybe he really likes it. So I mean, like I said, I think we're both a little befuddled by how he made this fairly dramatic turn from being kind of trying to push the market back from being too dovish to basically saying, that's fine. He's got no problem with the notion that the Fed's going to be on course to be lowering interest rates for a while. I would have thought it would make more sense to basically confirm what the market's expecting. You don't want to shock it and not cut rates in September. So just confirm you're going to do it in September and then just do the yada, yada, yada about data dependence. And
Yeah.
I mean, that was sort of in there, but it was, the clear message was we're on a easing course. Um, Eric, anything else you want to add before we kind of go off into the charts?
No, let's dive into it.
Okay. Yeah, I guess we should also point out that uh, because of our discussion about Powell, both Bailey and Max decided to attend, but they couldn't keep their eyes open. So, anyways, they're here. Let's go and have a look at some charts that are relevant to our discussion. Your dog's around there somewhere too?
Yeah, he plays fetch with himself by rolling the ball and then jumping after it. So he's having a good morning.
Those are the best kind of dogs where they can play with themselves and keep themselves busy,
Yeah,
sleep a
self-sufficient.
lot, and you only need to take care of them when you're in the mood. Eric, you put this chart together. You want to just give us a couple of seconds on it?
Yeah, I mean, I think this is a good way to visualize how the market's thinking about where interest rates are going. And you can see before, kind of all the carry trade volatility and then that non-farm payrolls report that shocked everyone. We, of course, chalked much of it up to weather-related impacts. But just a month ago, the path of policy the market was seeing was much more hawkish than what we're pricing in now. And even though the market volatility was kind of fading,
Eric,
but
it was less dovish.
yeah. Less. No, I mean this is the expected path of policy. The long term neutral rate that the market expects is around 3%. I think we're a little more hawkish than that. We think it'll be a bit higher, but that's where we're at right now.
Yeah, and we've had they're expecting rate cuts over the rest of the year that get us down to 4.5%. And then by the end of next year, we get down to 3% according to these expectations. And that's radically different from what we had about a month ago. So the market definitely is keying in some very dovish interest rate outlook. And I think the reason for that is people look at the Fed funds rate chart historically and say, every time the Fed starts to raise rates, they then continue to do it pretty aggressively for a while. But Eric and I have pointed out what's missing in that scenario now is that there's no recession, there's no credit crisis, there's no credit crunch. Maybe there was a credit crisis last year with the banking situation, but that was stabilized within a matter of days by the Fed. So history may not repeat itself exactly. We agree that rates are coming down in September. We're just kind of disagreeing with the amount of rate cuts that the market is anticipating. Um, by the way, speaking of the Phillips curve, again, if you look at the inverse relationship between the unemployment rate, which is the red line, and the year-over-year percent change in consumer prices measured using the consumption deflator year over year, you can see that the Phillips curve had some validity in the past. Namely, in order to bring inflation down, unemployment rate had to go up, or when the unemployment rate went down, inevitably inflation went down. So you can see these kind of oval experiences that we have here when that exactly was the case. And maybe by luck or maybe some insights, we came up with the idea that this time around inflation could come down without a recession, without the unemployment rate soaring. And so we've got this experience where inflation really has come down and the unemployment rate stayed extremely low. Some people are freaking out about it. It's going to turn up. That's the Sam rule idea that when you start to see the unemployment rate going up slowly, the next thing it does is it spikes up. And we've addressed that issue by saying, yeah, but that's because you get a credit crisis, you get a credit crunch, you get a recession. And this time around, so far, there's no gray. That doesn't mean we're not saying we couldn't have some event here that suddenly causes gray to be drawn in, but it sure doesn't look like that at this point to us, and hasn't looked like that to us for some time. And we're kind of proud that back in the summer of 2022, and Eric can take some credit for this because he joined the right firm, but he wasn't around with us. But back then in 2022, Debbie Johnson and I uh, suggested that inflation was actually peaking in the summer of 2022, and we drew some lines of where we thought it would get to in 2020, to the rest of 2022 and 2023. We didn't at that point extrapolate 2024 just yet, but when we got into 2023, we started to talk about getting down to 2 to 3% in 2024 and 2025 without a recession. And you know, I think partly that occurred because we had a significant round trip in durable goods inflation as China went into a recession depression and just dumped goods into the global markets. So that brought durable goods down. But we also argued, even in the summer of 22, without really knowing that would happen, because that's typically what happens. And we also argued that with a lag, rent inflation would come down. So it all worked out pretty nicely. And again, without a recession. Um, Even Powell mentioned that the unemployment increase was due to an increase in supply of labor relative to job openings. He noted that layoffs are down, and you can see this in various measures of layoffs, like the Challenger data shows that layoffs are very low. This is the JOLTS data on layoffs, and this is initial unemployment claims, which I think really is really one of the better indicators we have out there. And so that's why everybody's watching it, and we'll be watching it on Thursday to see whether it kind of stays here, goes down, or goes up. We're in the stays here or goes down camp because we think some of this was in fact weather related. Um, Eric, you want to tell us about Powell? I think he gave a speech in 2022. I think it was titled "Inflation and Unemployment." And he really focused on the, oh, no, actually, it was called inflation and the labor market. So he really focused on the labor market. And in his latest speech, he said that he's not concerned about inflation and labor market being a source of inflation at this point because there's still plenty of supply. You want to just take us through this chart real quick?
Yeah, I mean, it seems to be that Powell really focuses on unit labor costs or labor inflation as his, North Star for underlying inflation. What this chart shows is, there's more demand for labor than supply, so that kind of implies a hot labor market or a tight labor market. Those are kind of coming into better balance, so we're getting a more normalized supply and demand picture. Some of the hardlanders kind of think that this demand is going to fall off and there will be an oversupply, and then we'll have a loose unemployment or a loose labor market and higher unemployment. I think this chart clearly shows that we're still a little bit hot. We're just kind of normalizing. It was actually interesting in this morning's Dallas Fed survey, the Dallas Fed manufacturing, the number of employers who said that they're not hiring, they're not firing, staffing looks really good, jumped like 7 percentage points from the back half of last year, whereas layoffs because they're overstaffed didn't change at all. So really, it's just a normalization. The labor market's cooling off, but we don't think it's like deteriorating substantially.
Yeah, this is another chart that looks like it. I mean, actually, when you look at the short history of this thing, a normalization means that you're actually below this line. But we certainly have cooled off. Um, I guess when we look back over the past 30 days and say, what is it that freaked Jerome Powell out? Let's assume that he actually does want to retire and he's not looking to angling to get another term by being relatively by focusing on promising the next administration that he'll lower interest rates and keep the unemployment rate low. Let's just look at the past 30 days of what might have changed his mind so dramatically. And it could have been the manufacturing purchasing managers that came out in early August. There was a big drop there in the employment number to 43.4. And again, this is manufacturing. What is interesting, though, is that the big drop in employment, when you look at the same thing relative to what actually happened in manufacturing employment, it was up 1,000. So, I mean, that's not much, obviously, it's piddling, but it's not the kind of free fall that was suggested by this drop. And again, maybe the weather had something to do with it. Maybe just this thing gets to be a little ziggy and zaggy, and decided to zag instead of zig this time. Um, this is another slice and dice of it. This is the ISM National Manufacturing Purchasing Managers. Again, that employment index took a dive, and here we're comparing it to the average employment indexes of the five regional business surveys, and that didn't confirm that things are that weak. And again, that's just manufacturing, which is not the has not been the biggest source of employment gains. Bigger has been obviously services, and the services number that came out again in early August for July, the employment number actually jumped up. And again, this kind of made no sense here when you look at what actually happened on a per month basis to services employment. It actually was increasing pretty nicely. So, it's kind of like the Wizard of Oz. Pay no attention to the data behind the curtain here. That's just pretty ziggy and zaggy. And at the end of the day, it's the payroll numbers that are more important. But even they can zig and zag with the revisions we've seen. This is the latest data we have on the monthly changes. In on a 3 month average basis, 12-month average basis in non-farm payroll employment total versus private. Let's just go to the private here, and you can see that the private has definitely slowed down. But we're talking about a slower pace that's kind of consistent with what we had before the pandemic. So this looks like normalization to us. Um, Eric, just let's take a quick run through of inflation here. I mean, again, over the past 30 days, uh, I guess we agree that there's less reason to worry about inflation, failing to moderate. There's less reason to believe that inflation's suddenly going up. So that probably calmed him down about inflation. But again, we question, why get all why change the risk assessment and making higher unemployment a higher risk? Eric, we'll pass that. We've done this before.
Yeah.
Everybody knows our story. This is another story we've been telling. The CPI, excluding shelter, is 1.8, 1.7%. And we know that the CPI tends to be higher than the PCED. And here the PCED inflation rate's 2.5 for the headline, 2.6 for the core. So we're clearly on autopilot here to get it down, but not if Powell gets everybody excited and concluding that let's let the good time roll again. But we'll see how that plays out. Meanwhile, the economy is doing fine. Real GDP growth is 3.1%. The average over time is 3.1%. So that looks pretty good. No particular reason to worry about that. And by the way, Eric, you want to tell the folks what we concluded about this terrible drop in payroll in the payroll revisions, what the implications are?
Yeah, so I think one of the things is I think Goldman came kind of to the same conclusion as well. Is the payrolls numbers based on how the QCEW measures them? They miss a lot of immigrants. They're measured by state unemployment insurance taxes that employers pay. I estimated anywhere from like 280,000 to 550,000 illegal workers weren't counted. So we all know there's been a lot of immigration. I used CBO immigration numbers estimates to come up with that, and then some kind of historical employment figures. But yeah, I don't know. We know there's been a lot of illegal immigration. We know they've been working a lot. It just makes sense that a lot of those workers wouldn't be counted by
Yeah,
state unemployment insurance. But
yeah. And
yeah,
from a statistical perspective, if the government statisticians take those numbers as hard numbers, and they conclude that there were less workers working, fewer aggregate hours worked, we could definitely see a revision upwards in non-farm business productivity. And that would be consistent with our view, though we would moderate that some for the story that Eric just told. But as it is, productivity on a year-over-year basis was at 2.7% on a year-over-year basis. So it's, I think the historical average is about 2%, so it's above that average. And we're still thinking we're in the roaring 2020s where we're going to see even better productivity growth. Eric, I didn't share this with you, but I'm listening to an audiobook about Elon Musk, and I think we all need to read it or listen to it. He's sort of a combination of Henry Ford and I don't know. Uh, I'm thinking of somebody else, but I know what it is. Henry Ford and Thomas Edison, or I like Tesla better, but a combination of a manufacturing genius and just an amazing engineer. And he's working on robots, and I thought the progress they're making is pretty cool. And it turns out there isn't much difference between the technology, the engineering of a robot and autonomous driving cars.
Yeah.
But then I think in Bloomberg today, there's a story that there's a fair out in China for these robots, and there's about I don't know 15 companies that are aggressively developing these robots, and some of these things are going to be introduced within the next year or two. So
Hmm.
it could really dramatically increase productivity, automation, certainly in manufacturing and maybe even in services.
Yeah,
Uh,
I took a driverless Waymo
yeah,
this weekend, which was pretty cool. But yeah, real quick on the productivity point, I think like all else equal, assuming GDP isn't revised and work weeks aren't revised, the Q1 productivity number would jump from 2.9% year over year to 3.4%, which is
yeah.
pretty substantial. So it just kind of supports our roaring 2020s thesis.
Yeah, one of the reasons we thought that inflation would come down was because of our roaring 2020s thesis. We thought productivity would make a comeback. And guess what? Productivity growth was strong last year, and it's been strong so far this year. And it's one of the reasons, the other reason being hourly compensation is slowed. But the big reason why unit labor cost inflation has come down, and we've been making this point for a while, is that unit labor cost inflation has come down and now it's down to only 0.5%. And you can see it's not a perfect correlation, but it's a pretty good one in terms of determining the inflation rate, even as using the headline PCED, which includes energy and food. So that's been our story is that, the Phillips curve inverse relationship between unemployment and inflation has always missed the productivity story. And that's because sometimes the productivity story didn't matter that much because it wasn't that impressive. But we think it's has been impressive recently and will continue to be so. And so that's how we can get inflation down without a recession. Eric, you want to field the questions we have in the Q&A? And I'll put us back into mode where people can see my dogs. And if your dog comes around and wants to say hello, that's fine too. Eric, can't hear you. You're on. There we
There we
go.
go. This is first one from Ian. Your take on the potential upside to growth and employment relating to organizations waiting for rate declines to invest more in capex as well as pent up loan demand. Is there like a potential for a growth spurt, or are we continue to going to wait for the elections?
There's a potential for that. We just saw that in in the National Federation of Independent Business, the latest survey. I think it was July, Eric, right? There's a nice big increase in optimism, which was really pretty dramatic, considering that in these surveys, the small business owners seem to be suicidal. I mean, they were turning more and more negative, and we couldn't tell it was. I mean, it didn't seem like their business was bad. It just seemed like they couldn't hire anybody. It seemed like there was quite the opposite. It's like things were so good, they were just like kicking themselves that they couldn't expand. That was our spin on it. And maybe now that the labor market is normalized and there's more supply coming in, maybe they're seeing more opportunities to expand because what workers are actually there. So that's I don't know. Do you have anything to add to that?
No.
Okay, let's move. Go ahead to the next one from
All right.
Cactus,
This next
our good
one.
our good friend Cactus.
Yeah. So based on what we heard from Powell and Jackson Hole, what is the bar for a 50 basis point cut in September in terms of the unemployment rate and headline payrolls?
Well, okay. So for instance, would 4.3% unemployment rate and 100K headline payrolls be enough, in your view, given how Powell sounded on Friday? Cactus, you make it hard to answer that question, given how he sounded awfully dovish on Friday, and but I think that would be too much of a shocker. I mean, the market's built in 25 basis points. If they do 50 basis points, people might be wondering what's going on, what's wrong with the economy. And if we're right, the next batch of data actually looks pretty strong. Then the answer is there's nothing that really justifies 50 basis point cut. And then other people might start to speculate that this has more to do with Powell wanting to keep his job than anything else. Which, again, I don't want to think that thought, but the deja vu sense that we both got with Powell at the end of his previous term is we had to share with you. Go on, Eric.
Okay, so what are your thoughts on Trump's opinion that the president or executive branch should have a say in monetary policy? Thank you.
I'll let you do that, Eric.
Yeah, I don't think we sound any different than anyone else. The Fed should remain independent.
Yeah.
Yeah.
End
Otherwise,
of,
you get Arthur Burns 2.0.
yeah, and end of story. Look, the other thing is, by the way, is we are getting near the elections. We are going to have a new administration, and it's either going to be Harris or Trump, unless something else changes along the way, which, this year, who the hell knows? But both of them sound pretty inflationary for different reasons. And for the Fed to say we're on course to lower interest rates for a while here, basically that's what Powell said, is like insane, given that we're about to have. I get it. I get that the Fed has this view that they don't think about fiscal policy. They don't meddle in fiscal policy. They should think about it.
Mm-hmm.
They should have thought about it over the past couple of years, but they seem to be ignoring the inflationary potential. And you know us, we're optimists, we're disinflationists. We believe in the roaring 2020s. But we're not out to lunch. I mean, we are looking at the real world as it is, and our concern is we could have some pretty inflationary fiscal policy up ahead here, and the Fed could be setting itself up to basically accommodating that. So
Yeah, when
that's
you look at market expectations for inflation over the long run, they're about as low as they've been since March 2023. And that
yeah.
was like a recession type pricing in for why inflation will be lower.
Mhm.
Now, like break evens and inflation swaps are so sanguine, they think we're getting there over the long run, just with a soft landing. So,
Yeah.
so it's really optimistic pricing.
Well, so some people might be wondering, so why don't we change our tune and start talking about, a rebound in inflation next year, since we're saying no matter who wins, they got inflationary policies. And the answer is that Eric and I should speak just for myself. I'm voting for gridlock. I'm rooting for gridlock. Gridlock is the way our founders designed the system so that crazy stuff wouldn't happen. And so far, you got to admit it's worked remarkably well. And there are people, particularly on the Democratic Party, who hate gridlock and would like to get rid of the filibuster, would like to, pack the Supreme Court and do all kinds of things like that to get rid of gridlock. I'm not saying that Trump doesn't do his own bit to didn't do his own bit to get rid of gridlock through executive orders, but gridlock is what we're rooting for. Go ahead, Eric. We got a couple more minutes.
Um, I'm actually going to skip to
Okay,
bottom.
go ahead.
And Eric, great insights. Nobody's talking about this productivity upsurge except for you. Do you buy the thesis of the market broadening? And will international markets enter a bull market or rally with the dollar's decline?
Well, yeah, our take is that the market will broaden. I know a lot of people over the past couple of years have been questioning the legitimacy of the bull market because it was so narrowly focused in the Magnificent Seven, and we pointed out that it wasn't really that narrow. It's just that the Magnificent Seven outperformed to such an extent that a lot of companies who were up only a piddling 20% were viewed as underperformers. But it actually was a pretty broad bull market. On the other hand, the mid cap certainly lagged behind. And I think what we're discovering over the past several weeks is that they've just been waiting for rates to actually come down, not for for promises or expectations that they would come down, but they want to actually see rates coming down. So the Russell 2000 has been outperforming. We're still, though, in the stay home camp relative to go global. We'd still rather overweight the US rather than the rest of the world. We've been not just underweighting, but recommending staying out of China. We didn't pound the table on getting into India, but that's obviously been working pretty well. We're not keen on Mexico, mostly because of the way the politics are heading and the corruption and the lawlessness. So Mexico is not something we're favoring. Brazil is sort of a commodity play, and we're waiting to see more signs the commodity prices are picking up in order to play in that playground. One more question, Eric, if it's a short one.
People do want to know the title of the Elon book.
I think it's just called Elon, and
At
it's
the Walter Isaacson book?
yeah, yeah,
Okay, there you go.
it's great. I listen to it all the time. I get into the car and my Audible goes right on, and I mean he's a force of nature. He's an amazing individual, both on the positive and negative side. But his creative genius is really quite impressive. And I think what people are missing again, the pessimists are missing again, is technological innovation. There's a lot going on, and there's an amazing amount of competition, to beat your competitors in all these areas, whether it be robotics or artificial intelligence and so on. We at first we kind of weren't that red hot on AI because we tried ChatGPT and we found it to be full of flaws. But now we're using Microsoft Copilot actually instead of the Google search, and the Microsoft Copilot at least gives you references, and so you can open up the articles on which the story is based and do immediate fact checking. It gives you a lot of confidence that the Copilot might actually be getting it right. So we're getting a little bit more keen on that from our perspective. But I wrote a piece on artificial intelligence last week. Take a look at it and to see the positives and negatives, the pros and the cons there, and we'll be continuing to update that. As you know, Jackie Dougherty, our colleague, does a great job on a weekly basis updating what's going on in technology and with a lot of focus on AI. Eric, thanks for joining me. All of you, thank you for joining us, and we'll see you next week.
Thanks, everyone. Have a good week.